Hi, good evening. Welcome to the webinars of the CFA Society Hong Kong, which also this time we're glad to also co-organize together with the CMT. I think tonight I'm Richard Mack. I'm the moderator for the seminar of the webinar tonight, and we are pleased to have a very prestigious speakers, Mr. Sunil Garg, CMT. Who is the former head of the International Equity Research for JP Morgan, to give us share their thoughts on this very interesting topic. Time or timing is everything, and which is a very interesting discussion tonight. How to combine fundamental with technical and analysis. Which do they talk to each other? We shall see. Before that, we would like to go through a little bit of housekeeping. So as you may be aware, if you're familiar with our webinar, we have a Chatham House rules for all our webinars. So the participants are free to use the information received, but neither the identity nor the affiliation of speakers nor any other participant may be revealed. Please observe this rule. And also the content of this event is for information purpose only and not intended as investment recommendations. Please don't take. We won't give numbers, and we really appreciate your feedback. That we will receive a question, an email with a quick questionnaire. So tell us how we can do better. And last but not least, I want to make the webinar more interactive. Sunil actually told me he doesn't mind. You guys can come in the questions in between. We can chip into him, and then to actually don't necessarily have to wait all the way until the end. So please feel free to send your questions, type your questions in the Q&A box, and we will try to find the right moment to chip in and bring in the box. So now I would like to make a very brief introduction of our speaker tonight, Sunil Garg. As I mentioned, as shown, he's the former head of International Equity Research for JP Morgan. Now, I think it's a rare combination of a chartist and a fundamental analyst in both sides. Because Sunil has been in the market profession for over 25 years, going through multiple cycles, which is important because I think last 10 years we probably only see a bull cycle. Maybe we start to see bear soon. Well, with maybe Sunil can show you some hints with the chart. He started a career in the banking sector in India before moving to the market business based in Hong Kong and London, where he specialized in banking, markets, and macro research. So, without further ado, I would like to pass the floor to Sunil.
Thank you, Richard. Let me bring up my screen. Hopefully, that should be okay. All right. Hopefully you guys can see my screen and you can hear me okay. All right. I'm going to start. Richard, thank you very much for the kind introduction, and a big thank you to the CFA Society of Hong Kong and the CMT Association for this opportunity. And hopefully, the intention here is to keep it simple, but hopefully add some value. Now, time is something we've always been told. Time is money. We see this every day in our lives. You pay for time value of money. You earned time value of money, although in recent years that hasn't been very much. And by definition, this theory is really based on a linear equation, a linear unwind or with the passage of time. But when we come to freely traded assets, for example, equities, does this time value hold money? You can see the chart here that, and you can look at some of the commentary I've had from popular opinion, and very often popular opinion tends to just miss out turning points. But more importantly, when we go to time value of money, and let's say you expect an asset to rise 12% in a year, does that mean it's going to rise at a steady 1 percentage point every month? Hardly ever, if at all. Good afternoon. My name is Sunil Garg, and Richard, thank you for the introduction. And I'm now going to dive into some of the slides here. So first of all, the tussle between fundamentals and technicals is almost cliched. And I'm not going to be championing one or the other. In fact, I'm also not going to go too much into a discussion for the case for fundamentals or technicals or the difference. There's a ton of material out there in the world. But the fact is that if one analyst calls a stock, I'm just going to default to talking about equities, but you could apply that to any asset class, and another analyst calls that a sell, only one of them is going to be right. The question and the focus for the session today is, does there need to be a conflict between fundamentals and technicals? Can they work together? And I think this is really what I want to focus on. I will, for the sake of completeness though, run through a few quick slides on fundamentals and technicals and just, to set the stage. Let's first talk about fundamental analysis. I spent a large part of my working life as a fundamental analyst and managing teams of fundamental analysts in different countries. So clearly some biases there. And typically, and I will say this, that fundamental analysis is ultimately the bedrock. And typically, an analyst will look at a macro analysis, look at what the economic environment is doing, what the Fed is doing. You will look at industry dynamics. Ultimately, the industry needs to be in a positive phase in its own cycle for the companies to perform. You then get down to corporate analysis. You look at income statement forecast, balance sheet forecast, importantly, cash flow forecast. And you also then look at competitive advantages in a company. And then ultimately, a fundamental analyst gets down to valuation. Now, I will say something which might sound controversial, but ultimately the value of any asset is equal to the sum of discounted cash flows. A lot of you are probably saying, DCF, really? That's the worst valuation tool ever. And I wouldn't disagree, except I think the flaw lies and the problems lie in how DCF is applied, not in the theory of DCF itself. The theory itself is true, but forecasting cash flows and cost of capital, that's a whole different ballgame. And we'll talk about that in a minute. In fact, I would argue that almost all evaluation approaches, and people use price to earnings, price to book, price to clicks and eyeballs, price to sales, they're ultimately a derivation of the discounted cash flow. I'm not going to dwell too much on this slide, but and certainly the CFAs who are attending will be more than familiar with this, where I've tried to look at the link between what price to book and price to earnings is. And so ultimately, it's something which, that last bit should say price to earnings instead of price to BVS. But this is just to demonstrate that all valuation approaches ultimately will be similar. You take the value of an asset and divide it by earnings or divide it by book, and you just get a price to earning or a price to book multiple. Let's talk a little bit about fundamentals. And I mentioned a few moments ago that DCF has a lot of challenges in its application. So valuing an asset in theory is very easy, but when it comes to the practice, it's extremely difficult. I'm going to ask the audience a question at this point. So let's say you're a super forecaster, and I have no doubt that many of you are and follow this as a profession. And there are only 3 variables that you need to forecast, just 3 variables. And you can forecast them with 90% accuracy. And your accuracy absolutely does not diminish, no matter how further out you go in time. What is the probability you will get your DCF right? Any responses? Any thoughts? Quick answers? Richard, do you see any responses?
Let me see. Not yet. But well, let's see. What 3 variables you have to? I think it's like
any 3 variables in a company. You're building a model on a company. you have to forecast only 3 variables, and you can get them, each one of them right, 90% accuracy, and no matter how far out you go in time. What is the probability your DCF is going to be right?
Well, I think it's one of the pitfalls we always debate about DCF is like the terminal growth rate, because you're assuming someone who can grow perpetually forever at that rate. So that is a big assumption. That's a big assumption.
Okay. But I'm saying you're a super forecaster. You can do 90% accuracy.
There's one comment from Brett. Is that 90% accuracy? Are you kidding? My earnings estimates is about typically right only about 10-20% of the time when I was an analyst. Sorry.
Brett, let's assume you're a super forecaster. What do you think your DCF probability is?
And I guess someone to say earnings growth rate, discount rate, margin forecast.
All right. Let me get to the point. Effectively, no matter how good a forecaster you are, the probability your DCF is going to be right, even if you're a super forecaster, is probably going to be less than 10%, probably not even 10%. And the fact is that small variations will get compounded very quickly, and valuation forecasts are not that easy. You can forecast, sales, but if you get it 90% right, the balance 10% compounds against you pretty quickly. And then, of course, there's the fun aspect of calculating cost of capital. It's one of the most abused metrics by any analyst. But that's a discussion for another day. That's a whole different subject. But the point I'm really trying to get to is that your ability to value an asset is quite difficult as it is. And this is one of the challenges a fundamental analyst faces. But then you get to another aspect, which is, you've got 2 charts on the right that you expect, and typically most analyst forecasts will be a 12-month forecast. But the reality is that the unwind or the growth in the asset, or the decline for that matter, is not going to be linear. It's not going to be uniform. The reality might be a lot more volatile and a lot more choppy, even for a stock like Apple, as you can see on the right. And so, and I mean, another question very often is that we often look at price targets, which are 1 year out, but what happens if you achieve your price target in 2 months' time? Do you hold on for the balance of 10 months, or do you sell and go, right? So time is important, but timing, I think, is even more important, is what I'm trying to get to. Fundamentals are absolutely the bedrock, but they do have certain number of areas where you clearly need some additional help. And this is where we get to technicals. If you're a technical analyst, you're probably very familiar with a lot of the arguments for, but I'm just going to run through a few things. The chart that you see on your left is a classic demand and supply curve. And we all know that interaction of demand and supply leads to price. And very often when curves shift, trends often change. But the important point here is that ultimately demand and supply will reflect all expectations of future value at a given point in time. And this is really where I think the study of price becomes important, because when you are studying price, then you are in effect studying all factors, all expectations about the fundamentals in operation at that point in time. A very simple way to understand the link between fundamentals and technicals is technicals will study price, which are nothing but an incorporation of the expectations of fundamentals. So let me just say this one more time. Technicals study price, which incorporates expectation of fundamentals. So the two are not mutually exclusive, but the two are absolutely linked. It's just that price becomes probably one of the most comprehensive indicators. The big question, and this is perhaps a leap of faith for many, is can you use the study of price and historical price movements to forecast future prices? As I said, it is a leap of faith. If you're a technical analyst, you believe that the answer to this question is yes. And this is a very critical belief underpinning technicals. But let's just stay with this leap of faith for now, just to humor me for a few minutes, if you like. I'm also going to briefly touch upon what technicals can do and what it can't do. Now, perhaps my CMT qualification makes this list a bit more biased in terms of what technicals can do, is a little bit longer than what it can't do. But biases aside, as I mentioned, and I truly believe that price is the most comprehensive indicator because it effectively incorporates every expectation. Doesn't matter whether it's a rational or an irrational expectation, but ultimately that's what drives demand and supply, and that's what therefore drives price. And when you study price, you're looking at pretty much every expectation in the process, and very often, it's perhaps not too much of a stretch to say price is God. Now, price is important, but almost similarly, volume is important. How much volume is traded at a particular price is something which is got a lot of crucial information incorporated in that. You might have a stock trading at $100 and you have a traded volume of $50 million on a daily basis. And then you have basically one single trade, maybe $1 million traded at 125. Does the 125 become as significant given the low volume trading, right? And I think this price volume interaction is just something which technicals are in a very unique position to capture. We also live in a world which is very heavily linked across asset classes. And in fact, when you see market downturns, correlations go to 1. But these intermarket linkages, and we'll talk about these more as we go along, are pretty crucial. Understanding what is happening in the commodity market, what's happening in the interest rate market, what's happening in the cryptocurrency market is very important to understand what's going to go on or what's happening in the equity market. And this is really where the technicals picture becomes quite comprehensive in that sense. And I think it's also very useful. There are certain assets which have no cash flow. Gold has no cash flow. Bitcoin has no cash flow, unless, of course, you use a proof of stake and earn some money. But the reality is these are non-cash flow assets, and you can't really do a classic fundamental valuation on these. And this is where I think studying price becomes important as well. And of course, the last advantage is that there is no need to do a DCF. So therefore, no debate about whether you can forecast cash flows or weighted average cost of capital. Technicals has its own faults. You could probably say this to any form of analysis, but within the field of technicals, there is too much of a subjective bias. And you put 10 analysts in the room and you get, I don't know, 20, 30 opinions. But one of the things we often hear is, well, if the price rises above, say, $50, and let's say we are at 40, then it becomes a buy. But the question is, will it go from 40 to 50? It doesn't necessarily answer that. Now, there is a good reason why technical analysts do this, but for the user of technical analysis, this becomes a big flaw because it's too much of this, if this, then that kind of situation. One of the things I will say is we often hear that share prices either rose or fell due to technical reasons. I personally think that statement makes no sense. Ultimately, if price is reflecting expectations of future fundamentals, then it's the fundamentals and the expectations of fundamentals that are going to drive the price. Technicals don't drive the price. Technicals study price, they don't drive the price. So ultimately, fundamentals are absolutely critical, but technicals just help probably get there a bit faster and perhaps in a more comprehensive manner. Let's look at bridging the gap a little bit further.
Sunil, do you want to take some questions?
Yes, that would be great.
I think we actually have some. I guess it's like when we talk about price chart. You talk about historical movement, right? So you start the historical pattern. So when you're using the history to predict the futures,
Yeah.
because of building trend, are you talking about history repeat itself, or are we talking about mean reversal?
I think I would argue that there is an element of truth to both. The question about mean reversion is, ultimately there will be a mean reversion, but will it happen in the next 1 week, or will that happen in next year, is a very difficult question to answer. History repeating itself, no doubt. I mean, one of the arguments often against technicals is, well, if too many people look at the same pattern and say, oh, this is a head and shoulders, then does it become a self-fulfilling prophecy? But I think this all misses one very simple point, that ultimately the study in markets is a study of human behavior.
Exactly.
And I think the behavioral patterns, and I think there are some really interesting books written on the subject, where crowd psychology plays a very, very big role in how price gets shaped up. And a lot of the patterns that we talk about are ultimately reflecting the market psychology, human psychology, crowd psychology. And I think that really becomes important. I think if you go to some of the early origins of technicals and look at some of the really old classic books, they actually don't make mention of any mathematical indicators. So if and I think the CMT folks would be very familiar with a classic book on by Edwards and Nagy. That book does not talk about moving averages or RSI or momentum. It's purely based on patterns and psychology. But then modern technicals incorporates a number of mathematical indicators, which I certainly use, and some of them are just mathematically intuitive, and so therefore they become quite useful to look at as well. But I guess the long answer to the question, Richard, is that ultimately it's reflecting crowd psychology. Hopefully that gives some perspective.
Great. I think we have more to talk, but interesting. Since you bring up this behavioral bias, the behavioral finance, behavioral bias. So
yeah.
And one point I think is a very important thesis you talk about. Your assumption is like the prices should be a reflection of the fundamental expectations of the investors.
That's right.
So, i.e.,
that's right.
you're sort of a believer in the efficient market hypothesis, because is that the informations should be reflected in the price, right?
Yeah, well, let's put it this way. The expectations are reflected there. The reality and expectations can vary. And I would say the vast community of analysts, whether fundamental or technicals, would be 100% out of business if the markets were always 100% efficient. So there's definitely mispricing. But that, unless there are any other questions at this point, I wanted to actually jump on to, I want to pick up on that last point and move on to the next slide, if that's okay.
Please.
So let's bridge the divide between fundamentals and technicals. And I mentioned earlier that there are times when a fundamental analyst and a technical analyst are just going to be exactly opposite in terms of their view. Very often that precedes trend changes, but only one of them is going to be right? Now, if we look at a traditional fundamental approach, right, we briefly touched upon this. You'll look at a macro analysis, industry analysis, company analysis. You'll value the asset, and then you will make a price forecast. But effectively, your underlying approach is fundamental value is right, the stock can be mispriced. How about if you go the other way around? If you say the price is right, and then challenge the fundamentals, because typically we approach it as the fundamentals are right. This is my forecast. I think this asset is going to be worth $732. And if it's trading at 600, then it's a buy. But what about if the 600 is right? What's the problem with the fundamentals? And this is where reverse engineering, walking backwards from price, rather than walking forwards from fundamentals becomes important. As I said, if you believe that prices reflect all expectations and the price is right, then there is something in the fundamentals that needs to be challenged. That becomes a more interesting discussion, because then you're looking at what is the probability of that change. If you're looking at a stock where you think is worth north of $700, but it's trading at 600, and if 600 is right, and perhaps it's going to come off from there, then some of your assumptions leading to the 700 value probably will come under pressure. And challenging those and asking the questions of what am I missing becomes a far more interesting discussion, where what you're simply doing is you're challenging yourself, you're challenging the fundamentals based on what the price is saying to you. I'm going to take you through a couple of case studies just to illustrate the point. So this is an interesting case study of a company called Pandora. They make fashion jewelry. Some years ago, you had a company that was just growing fantastically. It was a great growth story. The sales were rising, margins were rising, the markets were expanding. They were going into new markets. The overall backdrop in terms of the economy was fantastic. And the analysts, and this is a real example, but I'm going to not obviously use names here. The analysts called the stock really well. And you can see that the analysts called a buy literally at the bottom and had a fantastic run up. And if anything, I think the analyst reputation absolutely went skyrocketing, as it should, given how well the stock was called. At the end of 2016, the stock was delivering what looked like a head and shoulders top. Now, technical analysts typically almost swear by a head and shoulders pattern as one of the more reliable patterns. The trend line was getting broken. The question is, what was going on? If you ask the company, the management basically maintained its guidance all through 2017. And this is despite the fact that sales were stalling, the gross margins were under pressure, the EPS trajectory wasn't particularly great, and yet the management guidance was very positive all through 2017. And the stock was on a ski slope. In 2018, the management admitted that the previous 18 months had been challenging, but was very confident of 5-year forecast. And in 2019, beginning, the management said that, oh, the business trends had been unsatisfactory, but they had put in place a transformation. Guess what? The stock was down 75% from its peak already. Now, the reason why I'm illustrating that is the price was telling you there is something going on. Management guidance will rarely, in my experience, tell you about a downturn. You know, some of you might recall the very famous statement from a certain gentleman called Chuck Prince of Citigroup in December 2007. The music is still playing and we're still dancing. That was, I mean, a classic market top statement, but the management is not going to give you a guidance about impending problems. And I'm not saying this to blame managements, but the reality is that oftentimes we are guided by what management is saying. But if we also incorporate what the price is saying, then the question is, what am I missing? What can go wrong in the fundamentals? Why is Pandora dropping despite all these rosy pictures? And that in some senses allows you and prompts you to do primary research, which perhaps gets you to stress test some of those assumptions. And this is really where in an instance of walking backwards from price to challenge fundamentals comes in. I'm going to give you one more case study. Oh, sorry. Apologies for putting that picture, which some of you might be familiar with at the Oscars, because when this presentation was done, this was a bit topical. But this is about the ARC funds. This was a poster child of post-COVID investment, invested in really innovative companies. I mean, Zoom was going to really zoom to the stratosphere. Peloton could do nothing wrong. And you had obviously, Tesla, one of the biggest holdings in the fund. The world was going to change. Everybody was going to be working from home, flexible working, everything. And I mean, if you really look at the blog sphere and the commentary about ARC, there was nothing that could be done wrong. Beginning of 2021, and I've got this little vertical line here where one of the technical indicators started signaling a sell. Questions what's going on. Around that time, the vaccines for COVID were coming in. The question is, would the world remain working from home forever? And you've seen, of course, the ARC Innovation Fund unwind pretty much all of its gains that it made from the bottom of the COVID, the rally from COVID lows. Now, if you look at the blog sphere, it's filled with trolls about, and people make fun of ARC. And it's almost trendless. I'm not saying that that necessarily means ARC has bottomed, but clearly it's unwound a lot of its fraud. And maybe the 100-odd companies it holds, 140 companies it holds, aren't going to be all that great, but not all of them are going to be completely useless either. So very often, again, the price will tell you about fundamentals, which you just need to challenge. And, price becomes quite important. When I did this chart, you see this little arrow at the bottom, which, started to deliver what the technical analysts call a positive divergence. I mean, the stock hasn't really, zoomed up, but it's kind of respected those lows, at least for now. And it could be an interesting stock. I'm not making a recommendation, but I'm simply saying that ultimately price is going to be pretty important thing to look at. I'm going to take you through one more case study, and then I'm going to pause for some questions. So this is a study on financials. I was a banks analyst, as I mentioned earlier, for a very large part of my life, covering banks in Asia, but I've covered banks in developed markets as well. And typically, financials benefit from rising rates. Well, look at the chart on the right. 10-year treasuries have just absolutely zoomed up. They nearly went all the way to 3%. They've eased off a little bit in the last few days. The Fed's starting to raise rates. So surely the financial should have been performing. But then look at the chart on the left. The financials are stuck. In fact, if anything, financials aren't doing well at all. It's a market sector that has been underperforming for a while. So what's the market saying? Should I listen to the theory about interest rates and load up on financials? Or are the financials telling me, is a recession coming? Is it the canary in the coal mine, to use a cliche? So again, I've shown you three different examples of where none of us knows what the future is going to be. And I think we've got to be absolutely humble as analysts to admit that we don't know what the future is going to be. But equally, price becomes a tool for challenging our beliefs, because that's ultimately going to make all of us better analysts. I'm going to go on to a few other things, specifically on intermarket technicals, but let me pause there to see if people have any questions at this point, and then we'll go from there.
Well, our audience like to type in the chat room rather than the Q&A session, so we also need to browse through that. I think we talk about, I think they all talk about volatility, how to capture volatility. There's a few things about capture the volatilities. Now, maybe since Sunil, link to your presentations a bit, so far we discussed, then certainly I think you're right that the price may not be obviously perfect reflection is of the reality. This is reflecting the expectations, okay? But that's then right, what people expect may not be. That's why you have chance to make money. Otherwise, it would be too efficient.
That's correct.
Right?
Yeah,
exactly. So, but on the other hand, it's like it should the price chart should reflecting all the market participant. I mean, because this is the consolidated. So So for those who participate, those who in the trade in the market would reflect it in the price chart. So are we saying that because in our fundamental and the CFA program also, we study about a behavioral bias, okay? So we said most people have a behavioral bias. So that's why they don't let profit run, they don't cut loss, those a few
Yeah.
trades. Then if you said the price chart is reflecting human behavior bias, so which means that should we say go against the chart? Because if the chart's reflecting what the human bias is, then is it the weakness that we should try to guard against us? How does it work?
See, I mean, there's a number of points you touch upon, Richard. I'll try and kind of unpack them a little bit.
Yep.
So, I mean, for sure that, there is a human tendency to cut the profits too early and let the losses run, much against what we've been taught all our lives. And that's just the, unwillingness to take pain, right? Taking a loss is painful mentally, financially, and, human beings don't want to take pain. And so you want to avoid pain and you want to push effectively losses, you run with them, right? So no matter how, and I think, to digress for a second, I think one of the things that you always hear is that to become a trader, the first and foremost thing you need to learn is discipline. If you don't have the discipline, then do not trade, because that's the kind of the biggest, causal factor for failure for so many traders.
Exactly.
But at the end of the day, as you said, that the price is reflecting collective behavior. You might have an individual investor or an institution that is behaving in a rational manner, which is cutting losses and letting profits run, while somebody at an individual investor level might be doing the opposite, right? It's the volume transacted at a price that becomes that critical information to, and this is really where the price volume study becomes important.
Exactly.
To understand where is the collective behavior going, because that's where the price is going to go. Now, I will also say one thing, maybe modestly digress, but just to illustrate the point, is I've heard and I've seen this with institutional money managers and individuals, where you bought a stock at $100, it went to $200, and then it fell to 150. And you're saying, well, I'm okay because I bought it at 100 and therefore I'm still in the money. But the reality is the price at which an individual investor enters a particular stock, long or short, is irrelevant for the market. Is relevant for the individual investor, but is irrelevant for the market, because every day is zero-based budgeting. Yep. And so your NAV is mark to market on the last night's close. And so from that perspective, your purchase price or your shorting price is not that much of relevance. So the collective behavior to me is more important than individual behavior. And I'm not going either against or in favor of the crowd behavior. I'm simply studying it to derive an expectation of the future. That's what I'm trying to do. I'm not forecasting behavior. Well, I'm forecasting price based on behavior.
Yep. Maybe you can take one question, which is, I think, I'm not sure whether you're going to cover later slides, but let's say, how relevant is technical analysis in long-term trend, say 1 year to 3 years, as it's difficult to figure out fundamental factors 2 years down the road? How do you reverse the work?
I think that's a really good question. I think very often we get told that technicals is useful only for very short-term trading, but is pointless in the long term. I actually don't believe that is true. And in fact, I will, try and cover it in one of the slides later on. But I think looking at weekly trends and, sometimes even monthly trends, monthly charts, gives you a perspective on where the long-term trends are. And I think one of the things, chartists and technical analysts are always taught is never trade against the major trend. So if, for example, the weekly trend is going down, then you do not want to trade a daily chart on the long side. You want to trade in the direction of the main trend. So in that sense, I do think long-term analysis is useful. Just like making a long-term forecast on fundamentals, like I think somebody talked about, not getting earnings right, 2-3 years out by a very high degree of accuracy. Any long-term analysis is going to be susceptible to that. But what I would say is that rather than saying, I looked at a weekly chart of something which tells me that this asset is going XYZ over the next 12 months, then just stay wedded to the view. And this applies to fundamentals and technicals. When facts change, views can and should change. I think that, to my mind, is absolutely axiomatic. There is no shame in saying facts changed, so my view changed. You can't say that I'm bullish on the market today, and therefore, no matter what, I'm just going to stay bullish, right? If the facts change, if the Fed, changes its interest rate policy, another discussion on the next slide in a minute, then my view should change, right? And I think, very often analysts will get criticized for changing their views, but if you're changing a view based on a change of the environment and the facts, that's totally legitimate. And in that sense, again, very long answer, but long-term trends can be forecast using technicals. In fact, I would say keeping an eye on the intermediate to long-term trends is super critical. Doesn't matter whether you're a fundamental analyst or a technical analyst. One more question.
Well, I think this is probably the next question about the Asian market. Maybe shall we save it a bit later? Because
okay, yeah, let's
I think because they talk about like frustration about like the reality, the frustration about, and it's like how come value cheap things keep cheap, stay
keep
cheap.
getting cheaper. That's the whole point. Price
Okay.
talks to you. Price is what you pay. Value is what you get.
Exactly.
All right,
So let's move. Let's move.
Let me talk a little bit about intermarket technicals. I briefly alluded to this earlier. This is one of the most powerful things which an analyst can use. I've got 4 charts here. On the top left, or let me start with the bottom right. You have inflation in the US, which is off the charts. Almost everywhere in the world, inflation is going, and it's not just driven by oil prices or agricultural prices, following the geopolitical problems, but it really is been going up even at the core level. But inflation is one of the typical inflation hedges we talk about is gold. And then you look at the chart on the bottom left, gold's going nowhere. I mean, basically, gold did a post-COVID peak around 2100, came down. Even if people think they missed the gold move, it went from 1900 to about 2000, and then it's given it back. Gold's going nowhere. If you're worried about inflation, something is not right. And if you then look at the chart on the top left, that is the 10-year minus 2-year treasury yield, which has been inverting. Now, this slide pack was done, a few weeks back. Since then, the curve has gone a little bit into positive territory. But the reality is that you've seen a massive flattening of the curve, which typically has had a very high signaling probability on upcoming recessions. I'm not talking about the timing of recessions, but no matter how many times you see a curve inversion and everybody starts to say, oh, well, this doesn't matter. But the reality is that it matters every single time. But if that be the case, then the S&P should not have been there. S&P should have been cracking a lot earlier. So there is a lot of contradiction that you're seeing sitting in the markets right now. But the question is, right, inflation is very high. The Fed needs to raise rates very aggressively, right? I think, I've kind of lost track of what the dot plots are saying, but there is between 7 and 9 rate hikes being forecast between now and the end of the year. But with an inverted curve, do we think the Fed's going to raise as aggressively? And if inflation is going to remain a problem, then does gold become a fantastic buy and equities have a lot further to crash? I'm not giving the answers here, But what this picture, one simple chart, one simple slide, is raising a lot of questions about the disconnect that you have today in different asset markets. It needs to get resolved. I do have a view on which way I think it gets resolved, but that doesn't matter. What matters is that intermarket technicals gives you a very comprehensive picture across asset classes. And I just put in 4 charts there. Somebody's, I know, wants to talk about Asia. All you have to do is look at what DXY is doing. And the different asset classes start to give you a question mark about what another asset class might do. And this is something which I find absolutely fascinating and very powerful as an analytical tool. So I just wanted to spend a few minutes talking about that. All right, let's talk about practical things. If you're a fundamental analyst, what can you do? What should you do, right? You can absolutely get lost in the vast number of indicators out there. In fact, I will, I don't have it in the slide, but I will make 2 recommendations that if you are interested in using a charting software, the one that I use is TradingView. It's tradingview.com. The free version is pretty good as well, but if you want to subscribe, I just think it gives one of the best, most comprehensive charting platforms, and it has hundreds, if not thousands, of indicators. You can get totally lost in those. That's not what I'm recommending. Keep it simple. Another recommendation from a resource perspective, if you want to learn about technicals, is go to stockcharts.com. You don't need to sign up. Go to their chart school. And I think that's one of the best resources on the internet and very reliable as well. But what I would recommend doing if you're a fundamental analyst is draw trend lines on weekly charts. That gives you a very, very simple visual representation of where the trend is going. And if that starts to break, that becomes a trigger for you to ask questions. So use the price action, use technicals to act as a trigger for you to ask questions and challenge yourself. You're bullish, stock's going up, it's respecting the trend, fantastic. But if it starts to break, question yourself. Moving averages are, I recommend 12 and 26 week, which is reasonably standard. It is something which is also, in effect, a representation of trend, perhaps a bit more dynamic. So something you might want to incorporate. I know as fundamental analysts, we're all, very often, enamored and we like mathematical indicators. So here's a mathematical indicator, which is a Z-score. And it's nothing but the difference between the price and its moving average divided by standard deviation. And do that on a weekly chart. And effectively, you will see that this oscillator will move between plus and minus 2 standard deviation. As we know, over a long term, if it's a normal distribution, you can capture all the movements with 95% confidence. It doesn't mean it won't go beyond +2 and -2, but that's when you really get a sense of when things are getting overly stretched, right? And so effectively, if you incorporate trend lines, moving averages, and Z-score, and use these as a trigger to challenge fundamentals, I think you would have enhanced your fundamental analysis by making this use of some simple complementary indicators by a very significant percentage. That's my view. What do I use as an analyst? I, first of all, in terms of the charts that I use, the 2 charts that you see here are both kind of very old Japanese candlestick charting styles. One of them is called, the one on the left is called Heikin Ashi, and the one on the right is called Renko. But without making it too confusing, I think the main thing I'm trying to do is keep my life simple and effectively filter out the noise so I can focus on the underlying trend. Because ultimately that's important, right? There is too much noise in the markets on a daily basis. And on that note, I'm going to just talk a little bit more about Renko charts. This is one of the forms of charting which is not very common even amongst the technical analysts. And so, hopefully some of the CMTs and the technical analysts in this webinar will, perhaps benefit from it. I find it as one of the best tools to isolate trends. You can see that this is a chart of the S&P 500 for over a very long period of time. The x-axis is not uniform because effectively the way these charts work is that the price has to move by a certain preset amount for it to register an entry. If the price is not moving within that, let's say 1%, it basically records no entry. And essentially, when you have these really minor moves, it ignores those. So it filters out the noise and focuses on what is the main trend. The choice, as with everything, an analyst has to make is the size of the filter. If the filter is small, it will give you faster signals, but more signals. And if you have a larger filter, it will give you fewer signals, but that's good for long-term trades. So again, if you're using price, try and keep it simple, filter out the noise, focus on the underlying trend, because that's one of the things that's going to help you understand when trends change. And then, kind of the last slide, so to speak, where what I use is, this is my go-to setup on my chart. And what you have is the price in the top section. You have a momentum and a trend following indicator in the middle. One is called price percent oscillator. Another one is called derivative oscillator. And then at the bottom, what I have is what I mentioned earlier, the Z score, which, as you can see, oscillates classically between a +2 and a -2 standard deviation to find extremes. That's my go-to setup. That's what I look at when I first look at a stock. That's what I look at. If it looks interesting, then I dig deeper into that. So with that, I'm going to go to Q&A. Over to you, Richard.
Okay, thank you, Sunil. I think it's hopefully make it a more interactive from our guys on the chat room or the Q&A. So I think one question, the first word is of frustration. So one frustration is that a number of stocks in Asia trade at a huge discount to NAV. So discount, sure, cheap, and they have solid balance sheet with little debt, yet the stock price languish and never seems to move despite the huge margin of safety. It almost seems psychology is driving these prices down as a reflection of expectations that investors have no confidence in management. So, i.e., in a sense, they're asking you, does it the price reflect, like, as you mentioned, right, this is reflecting the investor expectations, or to some extent, maybe a step I will move forward, like, how can you use charts to distinguish what is a value trap, what is a turning point?
Yeah, look, I mean, okay, can charts establish what's a value trap? Possibly. Let me give you a couple of examples. I used to be a banks analyst with a specialization in Korea. And I learned it the hard way that there was a Korea discount. And the Korea discount essentially was the fact that policy was volatile and unpredictable, and therefore companies operating in Korea would be affected by that. Later on, I remember when I started covering China, the investors would often ask a question: is China now becoming like Korea in terms of a China discount because of the policy volatility? And you mentioned about the balance sheet is solid, debt is low, the company is doing okay, but a lot of it really is down to the uncertainty about the future. And a very, very good example is what's happening to the China internet stocks is not about the fact that, sure, Alibaba's not had the greatest earnings outlook, but the fact is that there is so much policy uncertainty in that space that it's become very difficult for an investor to have a clear view on how the fundamentals are going to pan out. And the charts have been reflecting that, right? I mean, I think if you look at a share price chart of Alibaba that just tells you, what the market has been expecting. So I don't know if I'm addressing your question exactly, but the fact is that the confidence about the future is ultimately going to get reflected in your expectations about the future. And if the reality is better, sure, the share price might do otherwise.
Good. I know we have a few minutes left, but interesting. There's one thing is like maybe a more kind of practical question is the same question is like, how do you tell, or what kind of yardsticks or criteria you differentiate a good technical indicator from a bad technical indicator, or kind of useful or not useful in a technical indicator? That's when no good or bad, useful or not useful.
Sure. So again, given that I want to keep my life simple, I prefer indicators that are not too noisy, and they don't whipsaw too much. The trade-off there is that they will often be slightly late. But that's okay. And ultimately, the whole point of using multiple indicators is you're looking for confirmations. So if one indicator is signaling a buy, then I'm looking to see if there are confirmations from other indicators. You just gain that much confidence, which is why the combination that I use is some leading indicators like momentum indicators combined with some lagging indicators like trend following indicators, and that kind of gives me a complete picture. There are some indicators you will see which just change around too quickly, and that's good for some traders, and that helps if your trading style is very short term. But I personally find those pretty tough.
So you'll be a patient chartist.
Yeah, well, I think being a patient analyst is a good thing in my view. It's very easy to get lost in the noise.
Exactly. Let me see. We actually say there's actually questions trying to direct to us is about like let me see. Sorry. Would be interesting to know your view on the back of the financial charts you use in the presentations. So now, of course, you just tell them this is actually a lot contradicting. I recall you said that the four building blocks is actually contradicting each other. So now you are actually in the dilemma. Which one I follow? Which one is right? So they try to ask you, hey, Sunil, then you give me just don't just give me a dilemma. Tell me what you think.
As I said, we all have views, so take it with a grain of salt. But the one pointer I will have for you is I trust bond market signals more. So if bond market is saying that a recession is coming, I will have a greater emphasis on that. The second pointer I will have for you is historically, you look at any major cycle peak, financials will peak before the broader market. So they peak early and they bottom early. It's an early cycle sector in that sense. And I think the financials peaked last year. And the last thing I will say is that if you look at the earnings numbers for the entire financial sector, it's been a mega beneficiary of a post-COVID recovery and a very loose monetary policy in the last 2 years. The question to ask is that even repeatable? So short of giving a specific opinion, hopefully I've given enough pointers.
Got it. Well, I know we have, I think some of our guys would like to say, oh, let's do some practice. This is not, by the way, this is not workshop. At the beginning, we said we're not going to make any recommendations. I hope this is 1 hour. I think Sunil probably can stay here. If you're a workshop, you can go over so many things. You can last much longer. But I think hopefully today, I think the key takeaway is like as Sunil pointed at the beginning, very beginning. fundamental analysis and technical analysis does not contradict. It's not mutually exclusive. I mean, it's the I mean, being a good investor, you probably you and I would need to learn how to combine it together to help you. And indeed, I'm not to try to write for the CFA, but indeed, I remember, at least in my days, I haven't checked the curriculum. I have a section on technical analysis when I took my CFA program. So they also tell us you need to look at the chart. So right, so I think in the interest of time, we would like to thank Sunil for sharing a lot of very interesting thoughts and your wisdom with us. And for the participants, I think they asked whether we get the presentations. Yes, I think Sunil and kindly say we'll share the presentation with you guys. They will send out later. And there will be, because this one is on the tape, I think there will be also a video sections you can on the recording as well. So, but again, thank you very much, Sunil. By the way, he's from London, so he's going to. We are waiting for dinner. He's waiting for his lunch. So thank you very much, everyone,
right.
and looking forward to see you again in our next CFA Hong Kong webinars. Thanks, everyone. Have a good day.
Thank you, guys. Have a great rest of the week. Good luck with your trading. And as I just sent the message, you know, there's always going to be, you know, no dearth of questions. I'd love to stay engaged. If somebody wants to reach out separately, it'll be my pleasure. But have a good evening, and thank you for taking time so late in your day. Take care.
Thanks a lot. Bye. Good day. Bye.
Bye.